Hello, everyone. This is Brittany Button, long-term care insurance specialist for Art Jetter and Company. We are so excited to have Leon Fitch, Regional Vice President with EquiTrust, joining us today. As you know, we recently onboarded with EquiTrust and now have their Bridge solution available. For those of you new to Bridge, Bridge combines a fixed indexed annuity with a long-term care rider. Now you're going to find some opportunities with Bridge as they offer guaranteed approval for long-term care benefits. Now, before we get started, we do have some handouts detailing information on Bridge for you to download. Please make sure to take a moment to do so. Also, if you have any questions, please type them in the chat or questions section. We will take Q&A at the end of the session. So Leon, let's get started.
Awesome. Hey, Brittany, I appreciate it. And as you had mentioned, this is a new partnership, one that I'm extremely excited about. Art Jeter is perfectly positioned to take advantage of this product. And I'll talk about later in the presentation just some of the sales opportunities and why I believe that. You had mentioned guaranteed approval. That's one of the reasons for sure. Especially if you've lived in the traditional long-term care space and have had a case or two turned down and folks not qualify. So we'll take a look at what that means. So looking forward to this, and let's go ahead and jump in. So again, I'm Leon Fitch, Regional Vice President with EquiTrust. We're going to talk about Bridge, our asset-based long-term care product. Before I do that, guys, I like to talk about, hey, who are we? I try not to assume that anybody knows, who EquiTrust is and what we're all about. So I spent a couple minutes doing that. So we really take a product simplicity approach. And competitiveness probably sounds cliche to some degree, like, hey, yeah, of course we want to be competitive, right? But I think that we are unique in that we are competitive across our entire suite of products, so we can fit, in pretty much any client situation. You're going to see that with this product, Bridge. When you talk product simplicity, I try to do the best I can to boil it down to the key components, the things you need to know, and not muddy the waters, because this truly is a simple product. The issue is clear, right? We've got a problem in the long-term care space, and we've got a solution that can fit, any situation truly. So product simplicity and competitiveness, transparency and integrity. Again, these things you probably see every company that comes out here. Hey, integrity matters to us and all those things. And I believe that for the companies that are in our space. I think we show it. Okay, you can go on our website and look at our renewal rate history for any product we have since inception that has a renewal rate. I think that's huge, because we sell a lot of trust me products, and to be able to say, hey, we're going to ask you to trust us, but here's our history, here are the previous answers to the test, I think is really, really big. That also bleeds over into our service standards. You can go on our website and look at, hey, if we submit a piece of business on Monday, we'll post our new business processing times for business in good order. Whether it's 5 to 8 days, 6 to 9, we tell you, hey, you submit a good piece of, a clean application to us. Here's what you can expect. Quite frankly, we usually over deliver on those times. We're really conservative. So if you see 6 to 9, I hate when I say this, by the way, if you see 6 to 9 days, it's likely less than that, but we try to give ourselves a little wiggle room if in case we've got a promotion or something going on that is driving a little, maybe a spike in business. So I think that transparency piece is big. I think it speaks to trust in a relationship. Sales concepts. We're a little unique. We try to compare not just product or provide product, but pair that with a concept, whether that's our inherited IRA program, which is the most friendly, both client and agent program in the marketplace, or our PTC, partial tax conversion program. We've got some concepts as all these trillions of dollars are exchanging hands here in the next 10 to 15 to 20 years, a lot of that's going to be in the form of inherited dollars, and having a carrier that understands that space, that is flexible to create a positive customer experience is a big deal. Okay. And then a high level of customer service. No carrier's ever gotten on here and said, guys, customer service, we really try hard. We're not really good at it, but we give it our best shot. So I understand when you see this, you kind of think, okay, but I can tell you that when I was going through the interview process with EquiTrust, they spent more time talking to me about my service mentality than my sales mentality. I was confused. I went home and asked my wife. I said, I think this is a sales facing opportunity, but it really sure feels like they are spending a lot of time talking about service. And now that I'm here and I've been here for a while, that makes a ton of sense. We really want to process our business in a timely manner. Again, we post our new business processing times. That 42% increase in new business processing staff is a really outdated number. It's probably closer to 50% today. So we're putting our money where our mouth is. As EquiTrust has grown, almost doubled from a premium perspective in the last 18 months, we've also increased the staffing, to support that and make that a sustainable deal. Okay. So that's kind of why EquiTrust, who you're doing business with, why you should be excited to work with us. Again, a lot of great carriers in the world, gang. We get that. We think we all have our own unique space, and we're no different. I think we've got some places where we really shine. I think service, product simplicity, transparency, those are all things that are staples here at EquiTrust. So, all right, let's jump into the meat and potatoes of this. Okay, Tom Hegna is, if you may or may not know who he is, pretty big name in the annuity space. He's made a couple of comments lately, right? One, nothing can destroy a retirement plan faster than a long-term care event. So if we have any office fans on here, you'll know who this is. So just having a little fun with it, but also that a long-term care event is a potential $1 million bomb being dropped into a retirement plan. Okay, so just think, we're going to walk through that math here in a little bit. So the agenda is simple. I'm going to set the stage. I work this backwards. I show you, we identify the problem, which I think most of the folks on this, on this webinar kind of understand the long-term care space. I'm not going to skip over it, but understanding that's the audience, I'm not gonna spend the bulk of my time, educating the people that already get it, right? So we're gonna set the stage. We're gonna get into the product details and then really focus in on, hey, where are my sales opportunities, right? Who should I be targeting? All right. So this slide should be titled "The Problem, Not the Reality." Okay. These numbers will look familiar to most of you. Okay. 90% of long-term care, traditional long-term care companies no longer are accepting, new issue policies. Those that are, 50% or more of those are being declined. So so we got this really vast problem, right? Depending on the source you use, 6 or 7 out of 10 of us are going to have some form of long-term care need in our lifetime. So we got this huge problem in this small window in the traditional space to solve it. 66% of folks say healthcare and or long-term care costs are a primary worry. 70% of families 70% of the long-term care costs are absorbed by families. If you live in this space, you know this to be true. And by the way, if you've had a personal experience where the proper planning has not been done, you absolutely know this is the case. And I can speak to that more than once in my life, both for my mother and currently my mother-in-law. So that's a real issue, right? We start talking about the caregiver strains, and I spent a little time on that. And 88% of adults 50 to 80 want to age in place. I always think some of these numbers are a little conservative. I think that comes down to control and comfort, right? Being able to age with dignity and age where you want. And I think Bridge allows us to do that. On the right-hand side of that slide, as soon as these slides are compliance approved, they're out of date, in my opinion, right? Because we know the inflationary pressures that are being, put on, or that are in the healthcare space, the cost of traditional long-term care, and then skilled nursing, assisted living, home health. These go up almost on a daily basis. Okay, the care is not as available as it needs to be. The options are limited, which then drives the cost up. And then the residual value of unused long-term care insurance policies is typically zero. So kind of take that one and set it to the side, because you're going to hear me talk about Bridge being a have your cake and eat it too type of product, right? So, hey, if I'm going to give you this asset, is my money now gone? Okay, and it is not, right? So we're going to talk about that. Hey, when you start to realize long-term care is really more about, or as much about, the family and friends as it is the client, right? When we're talking caregivers here, And I'm not going to spend a ton of time on this because I think most of you understand this, but man, I can speak to this intimately, right? 69% of family and friend caregivers report having to rearrange work schedules to provide needed care. I always apply these things practically. So I have 8 and 12-year-old sons. My wife works full-time. I work full-time. Okay. Now drop another human being into your world that you have to care for. Okay. That just doesn't happen without things being given up. Okay. Without help of some sort. Okay. That's real. The financial strain we touched on in the last slide. Again, in America today, most folks can't just add 26% to their budget and carry out about their day. They're giving something up, right? Whether it's their personal savings and retirement, that nice vacation, kids, sports, travel, whatever, something goes away. And then the last three, the emotional, physical, and social. Emotional, social, and physical. Those are real. I always use myself as you guys can't see me, but I'm I'm 6'1", north of 200 pounds, and my wife isn't, right? So her trying to get me to the bathroom or the shower and all the things that would come with a person needing to provide care without help, those are real concerns. So I just don't, those should not be overlooked. I think most of you on this call get that, but boy, this is where, to me, this is where the sale is made. Okay. The caregiver, hey, they want to do this because they don't want their son, daughter, wife, whoever the caregiver would be, to deal with some of these things. And that's how I would sell, if I was in a customer facing position, how I would sell the product. So what has Bridge done, differently? Okay. And the two on the bottom, okay, long-term care coverage, okay, no brainer. Leon, we got to provide a solution for the long-term care need. Okay, so that's primary. The second kind of underlying thing there is the ability to protect and grow an asset. With other hybrid products, whether it's in the life space or the annuity space, most of them miss here. Okay, I say most, I think all. Okay, quite frankly, based on what I've seen, what's currently available in the marketplace. The ability to, hey, you give me $100,000. Well, Leon, in 5 years, is that thing going to be worth anything? And then what if I never use my long-term care? Do I have a dead asset? And the answer to that question with Bridge is no. And I'm going to illustrate that for you later. So this is back to that have your cake and eat it too piece. And then the wellness side. And this is where our partner Assured Allies has really, I think, changed the game for us. Okay, they handle both our wellness program, which I won't get into great detail today. I will talk about it, but also our underwriting and the way we look at underwriting, okay? And what that's just I think a game changer from a product perspective, a customer experience perspective, an agent experience perspective, to really simplify the process, okay? So why Bridge? Okay, so here's some bullets. I've done presentations where I've had 10 minutes, and this is the only slide that I've had. Okay, and what I usually do is say, okay, there are a few things here that if you're going to take a picture of or make a note about, you need to highlight a couple of these. Okay, don't get tied up too much in the fixed index annuity chassis. We're going to talk about that. I know if you're not in the annuity space, sometimes that can be intimidating. Don't let it be. I'm going to simplify that for you later. It's just how the product is built, how the math works. Don't worry about that, okay? It's actually an extreme positive to the financial side of this product, okay? Flexible premium. So any year one premium will get the benefit of the coverage ratio. I'll illustrate that here on the next slide. Simplified underwriting with guaranteed approval. So I want you, as you're sitting at your desk or in your office, I want you to say that out loud and don't laugh, okay? Because that's a real thing. Simplified underwriting, which no matter what product line you're in, sometimes that's hard to believe. And then guaranteed approval. There is no yeah but, gang. It's guaranteed approval. You can have someone in a home today, they will qualify for this product. Okay, I'll talk about what that looks like later, and it'll be the best worst case scenario they could ever have, okay, and have a financial benefit from a long-term care payment perspective. All right, so that's that first one I put a big star on. The wellness program I touched on, and then an indemnity claims process. What that means to me is that is control of care at the client level. I'm going to talk to you about how we qualify claims. This will not be new to you. 206 ADLs and or severe permanent cognitive impairment. Once we have a claim, a qualified claim, we pay our whatever the benefit base is out over 60 months. That money goes directly to the client, and then they have control of care. Yes, and I get pushback occasionally, like, well, Leon, what about this? If they hire a family member, is there a taxable issue there? Potentially, right? You get into work comp in some states and things like that. So we always say, hey, look, make sure you're talking to an accountant, and we don't want anybody to get into a tax situation, but nonetheless, it's better to have control than not have, right? Chasing receipts down, getting pre-approvals, going through all the noise. We have a competitive carrier that, they've got a concierge program. And I always joke, I'm like, you don't need a concierge program if they control their care, right? And you just don't. And, we believe that control of care, simplicity, and at claim is a really big deal. And then a completely digital. So that was number 2, where I put a huge star next to that one. And then next one I would as well, completely digital process. All right. This can be intimidating the first time. So if you were used to be a paper app person, and now you've gotten into some carriers will only take digital apps, right? E-app, and you're like, after the first time, you're like, oh yeah, this is better. All right, because I can't make a mistake. They've kind of made it to where it really I don't like the term dummy proof, and that really applies to me. Most of you are a lot smarter than I am, but makes it hard to make a mistake. And then I'm getting business in good order, and my new business processing time is better. Think that here, right? The first time through, it's going to be a little different. Okay, let us help you with that. We've got a lot of resources to get you through that process. So yeah, I'd put another star next to that one. So for me, it'd be the 3rd bullet in the 5th and 6th. Okay, where I'd say, hey, these are the key things I got to dial in on. Let me show you an example. All right, David, 65-year-old retired guy, single with 3 grown kids. He has the same 3 objectives that we probably all have. They may be in a different order, right? Living independently for as long as possible, preserving his assets, and he doesn't want to be a burden to his children, right? And need assistance as he ages. He's got $100,000 of initial premium. He's preferred, okay? And people are like, well, yeah, you show preferred because that looks the best. Well, 66% as of yesterday of our folks that go through underwriting are rated preferred. So hear what I said there, that go through underwriting. We do have 5, and I'll show you these in a minute, 5 initial application questions to where someone can immediately become secure issue. Right, if they're in a home, right, they've got a mobility device, so there's some things that kick them down to our guaranteed or secured issue underwriting class. Well, they don't have to go through underwriting. So we kind of pull them out of the pool. So those that go through underwriting, 66% of those get preferred. So this is not a unicorn, okay? It's just not. The majority, quite frankly, of folks are getting preferred. So with that, because of his age, and I'll show you a grid later, and I think that Brittany added. If not, I'll get it to you guys. I'm looking at the takeaways. And Brittany, I know you're listening. I'll get you, if I haven't already, I think I did. I'll get you the full coverage ratio grid. But essentially, all that is his age is 65. He's preferred, so that gives him a 315% coverage ratio. Okay, so he gave us $100,000 at 315%. His initial coverage ratio is $315,000. At this point, you probably should be thinking this is too good to be true. In all honesty, that the first time I got walked through this product, I'm like, well, this is, they're going to spend, if this guy has a long-term care event, which 7 out of 10 of us are going to have, he's going to spend the $100,000 anyway. Why are you giving him 315, and how does that math work? Okay, we'll talk about that, here in a little bit. So what's that look like at claim? So 10 years later, this guy, had a, healthy living. He's participated in our wellness program, which some real dollars and benefits, really can be applied to. He developed an illness, qualified for his long-term care benefits. And what's that look like? Okay, don't get too tied up in these numbers yet. I'm going to show them to you on the next slide in picture form. If you're like me, I like pictures. So new benefit base. Okay, so he's had that initial premium or initial benefit base was $315,000. Remember? Well, for 10 years, he's been taking advantage of our 2% guaranteed annual roll-up. Okay, so he's had 2% growth for 10 years. That has bumped his benefit base to 383, call it 384. His wellness credits, I'll talk about that later, but essentially he's participated in our wellness program, getting his hearing checked. He's doing yoga. He's got a gym membership every 2 years. We check in, we evaluate that, we provide a score and the real benefit dollars that are associated with that. He's added another 27,000. So his $100,000 of premium, right, has turned into $411,000 and change of tax-free, okay, because this is a qualified long-term care product benefit. Divide that by the 60 months that I mentioned earlier, he'd have $6,853 monthly to help pay for his long-term care benefits. Okay, so what's that look like in picture form? There's that 100 grand initial. Here's his 315,000, and here's the yeah but, right? When you're like, oh, how does this work, right? And this isn't a yeah but. This is how the math works, okay? And by the way, there's some advantages to this from a cost perspective, but the vesting period is day one. They're 20% vested in the net amount at risk. Net amount at risk is the difference between this initial premium and his coverage ratio. So in this case, it'd be 215,000. So you do 20% of 215,000. Day one, that's their benefit. No matter if they're in a facility today, they can go on claim and take advantage of that and get that money paid out tax-free. Where the magic is in this product and why the wellness program is such a big deal is we want to get them outside of that 4th year in one day, right? So it's 20, 40, 60, 80 from a vesting schedule, and that's per year. So then day one of year 5, essentially, they are 100% vested, and then that benefit base is they're fully vested in that, and that's what their benefit base, which is what I illustrated on the last page. They're going to divide that by 60, and that's going to be what their monthly payout is. Here's the have your cake and eat it too piece. Remember, he gave us 100 grand, right? 10 years later, that thing's worth 184 and change. I'm going to show you some of the rates, later. I'm going to really simplify that for you. But this is a have your cake and eat it too product, gang. For that to perform as it has with this long-term care benefit is incredible. Our cost structure there's nothing like it in the marketplace. I'm going to show you that later as well. 2% daily compounded for 20 years. So essentially 2% roll up on that for 20 years. If you have any understanding of the income rider, a world in the annuity space, you have that accumulation side, which is on the left. On the right would be the income side. Well, just replace the income side with the long-term care rider. It works very similarly to that, okay? Except most income riders only will go up to either the lifetime of the product or 10 years. Ours will go for 20 years. And then the wellness credits, that's how we got to the 411, right? So that's just kind of to visualize how that works, all right? So let's get into some of the product details, the nuts and bolts. And guys, don't think you have to remember everything here. We've got a ton of resources. Several of those are already attached to this. You can download. Those are, great resources. Our microsite, which I'll get into. So don't think, boy, there's a lot here to learn, because it's really not once you've gone through it a couple times. Issue age 55 to 80. Minimum premium $50,000, non-qualified dollars only. Okay, so you're looking at folks with some cash, CDs coming due, some money, the money market, accessible cash. We're finding a lot, and I'll get to this. A lot of folks getting 1035 exchange money over into this. That's where we're getting our biggest contracts recently. It's a flexible premium product. What does that mean? So flexible premium, they can put premium into that more than once in the first year, right, and get the benefit of the coverage ratio. But they can also put money into it after year one. After year one, though, it's dollar for dollar. Okay, they don't capture that coverage ratio, which is still okay, because remember, the benefits are paid what? Tax free, right? So they still win. Okay, depending on whatever their tax rate is. So very typical with FIAs this year, or right now, 10-year surrender, 10% tax-free withdrawals or penalty-free withdrawals after year one. 5 index options. I don't want you guys to get too caught up in this. I'm going to show you this on the next screen. So our fixed rate currently on Bridge is 5%. That's where the vast majority of the money is being allocated today. A, because it's simple, and B, because we do have some folks getting into this space that aren't comfortable talking through the various index options, and that's okay, guys. We've got a lot of resources to get you there. We, meaning myself or Brittany, we've got internal folks, we've got a sales desk that will help you, and they will educate you on anything you want to learn. The reality is, right now, the vast majority is going into that fixed account, And here's the beauty of it. There is zero correlation. So you can't mess this up, okay? Zero correlation between the index you choose and the benefit the client gets. The only correlation there is the initial premium, okay? Right, and then the 2% roll up and the wellness credit. Those things that so the accumulation side can extremely underperform, right, and end up at minimum guaranteed rates, which we don't anticipate. But if that were to happen, it doesn't have any impact on the benefit side, and that's why we're selling this product, guys. So you can take that angst away from obviously yourself and the client. Right, this what we're talking about here with rates really is that have your cake side, right, where they want to make sure, hey, what if I'm one of the 3 out of 10 that doesn't use this product, right, or doesn't need, long-term care, and then, or I pass away before I use it, and I want to leave this to my beneficiaries, and as my asset grown, the answer to that is yes. Okay, so remember, totally separate any angst or questions you have. Hey, well, what if I'm not an expert on these indexes, Leon, and what if I make the wrong decision? Now my client's long-term care coverage has no impact, zero. They're not connected at all. Long-term care rider. Okay, so I touched on some of these. The main thing here to talk about is the maximum year one LTC coverage is $1 million. And how's that play out? Say you've got, like David, I showed you, let's say that he wanted to put, 500,000 into his account, right? Well, he had a 315% benefit, or I'm sorry, coverage ratio. Well, we can't have an initial benefit base of more than $1 million, right? Now, we've only run into this a handful of times. Really, all you do there is reduce. They can actually, the coverage ratio is the maximum. The client can reduce that percentage down, and the reason, I'll show you why they would do that here in a little bit, really because it changes the fee to the rider. And makes it much more beneficial to them. So they still end up with $1 million, but then their fee would be lower, and obviously then the accumulation side then would grow a little bit better. It has no impact on the benefit side other than the coverage ratio, right? And by the way, this is a great problem to have. You have a client go, hey, I want $1.5 million. Well, we can only give you $1 million. All right. So this is a good problem to have. Here's the coverage ratio grid. This is a snippet of that, okay? So we got preferred, standard, secure. The math is pretty simple. So if you got a 55-year-old that preferred is 325% is the max, okay? So you can see every 10 years, it goes down 10%. So 55, 65, 75, right? Track that math, go to standard, and then just take 100 off of it, all right? So pretty easy. Now, there's a different percentage for every age in between. So I'm just showing you an example. We can get you the full grid, so a 56-year-old, would be 323, right? But then secure doesn't work it's not quite as linear as that. So you can see even a 75-year-old at our guaranteed issue gets 130%, right, of their money. So if you got somebody that's like, hey, I'm going to self-fund this thing, why? At worst, you can get 130% of your money in a benefit base. Today, you're only getting 100 because that's your money. It's in your account, okay? So this is that best worst case scenario that I kind of talked about earlier. The microsite, this is how I learned the product, gang. I got on our microsite. It's got everything that I'm showing you, every handout that Brittany's attached, right, are on there. You simply click the state of sale and it will give you all approved customer facing pieces. There's an awesome calculator. I would use that as a sales tool. It can spit out a PDF for you. Once you get to a place, you click it and it really recaps all the key factors and things about long-term care and the long-term care need and bridge that you can email to your client. It's slick. Illustration software is in there, all the application stuff. Underwriting videos, licensing, you name it. This is a world-class microsite. I've seen a lot of these. This is the best one I've ever seen, okay? Other than hearing other reps, guys like me do this is how I learned the product, okay? So I encourage you to get on there and just poke around, right? Underwriting. So here, remember, this is one of the things I told you to kind of put put a gold star next to. Okay, so this is a differentiator, right? So so remember I said, kind of an oxymoron, right? Quick decision on underwriting. If you've ever been in the life space or heck, the P&C space, it doesn't matter, right? Anywhere, the quick underwriting decisions, sometimes it's hard to come by, right? So we have 3 underwriting classes. The 2 are pretty obvious: preferred, standard. Secure is our guaranteed issue. Okay, that's where, hey, we got somebody that, they've got some issues. We'll talk about the 5 application questions here in a second that can knock them right into secure, where you really don't have to go through underwriting. Then that's where they'd end up. But look, this is a state-of-the-art underwriting process. It's about a 25-minute video interview. Okay, it's just like this. If you could see me, okay, it's like a go to webinar, Teams, Zoom, you name it. Someone sits down. And they verify their identity. They've got to be in a space where they've got pretty good internet access, where they can be seen, and they're going to perform a series of cognitive and physical activities, and then they're going to be placed in one of the 3 underwriting classes. Again, I've touched on this: long-term care benefits, 100% guaranteed approval. So no medical, no prescription records, no blood draws, no doctor records. So just let that sink in for a minute, right? There's 5 application questions that initially start the process, right? Does the person currently reside in a nursing home, assisted living facility, something like that? Number 1, okay? Number 2, do they need assistance with any of the 6 ADLs? That's number 2. Number 3 is they use a mobility device, a wheelchair, a scooter, something like that. They answer yes to any of those 3 questions, okay? They're automatically put into the secure issue underwriting class, okay? If they answer no to those 3 questions, we continue, right? Question 4, they received SSDI in the last 5 years, okay? And then number 5 is the general health question. Have they been diagnosed or advised by a member of the medical profession as having or been treated for any of the following conditions in the past 5 years? It's the biggies, guys: heart attack, bypass, stent surgery, COPD, chronic kidney failure, cancer of all the cancers, right? I can read them, but half of them I can't pronounce, unfortunately. But and you can actually answer yes, depending on the time frame of when they've had that, and they can still get standard. Some have gotten preferred. We've had 2 or 3 cases we've had 2 that have gotten preferred. 2 folks that have Parkinson's that have gotten preferred. Okay, so let that sink in. And another that got standard, right? So I get this question all the time. Well, they have this. Well, did they answer no to the first 3 questions? They did. Then put them through underwriting. Don't self-underwrite this thing, okay? Put them through the 25-minute underwriting process, and you might be surprised, okay? So this is a game changer. Again, once you go through it the first time, right, that you're going to be comfortable with it, all right? But you got to go through it. We've got some videos that really are great prepare the patient stuff for the client and for you, just to understand what to expect. I like to tell agents to control the environment here, meaning have this in your office if at all possible, in a conference room somewhere, in an office where you've got good internet, we've got a good cam. So again, control the process as much as possible. You can't assist them in the interview, but you can assist them in setting it up, right? So, all right, so let's talk the fees and costs. I talked about this earlier. There's a 1% premium load based on a first-year premium only. There's a $100 charge for the wellness program. That's year 1. They have to have that. After year 2, they can opt out. We've had very few people opt out of it because there are real dollars and real benefits to the wellness program, but it is good to talk about that. And then the long-term care rider, right? This is where I get a lot of the questions, is based on the net amount at risk. I talked to you about that earlier. That's your base premium. And whatever your initial benefit is, well, initial and then ongoing as it grows, the difference there, so, when I said there's no connection and no negative to the accumulation value and the benefit base, there actually can be a positive. So if we are in a really nice rate environment, which right now we are, and that accumulation value continues to grow, right? So remember the guaranteed roll-ups is 2%, which is solid. But what if our accumulation value is growing at a higher rate? Well, the fixed is 5, right? So it's actually catching that benefit base number, and by doing so is shrinking the net amount at risk, and in so shrinking the expense to the rider. So that's pretty cool, I think, anyway. So let's look at that. Okay, so again, our charges are typically lower over time comparatively, because instead of being based, the rider charges being based on the full accumulation value as some carriers do, we base it on the net amount at risk. Okay, and what's that look like from a math perspective? Some more pictures, right? So here's some competitors. One America, who by the way just came out with a product is similar to ours, as I've seen. It's still not the same, but it's flattering when other companies, we're usually, quite frankly, as a relatively smaller carrier, trying to, kind of copying the chassis of other products. We've got folks copying us here. Their average cost there's 2.4%. For care, Global's 1.57, 51 bips, gang. That's an incredibly affordable fee on average. I'm going to show you something pretty cool here in a minute, that our folks that are secure issue, the perception is the worst risk, right? Well, they can't even, they're guaranteed issue. They're either in a home or they've got some kind of physical issue. Well, they should be the most expensive, right? Remember, it's built on net amount at risk. Okay, so what's the cumulative effect on our, remember the have your cake and eat it too portion, right? So and we still want that accumulation side to grow. What's the effect on these charges on the accumulation side? Right, so average return 1.06, 393, 6.34 is our average rate of return on our accumulation side. Guys, that's awesome. Okay, so you can sell to a client. You can give me your money, your asset, and it's going to grow. This would be a good investment standalone. If there was no long-term care side, this is still not a bad place to put your money, right? To get 634, on average on your money. Okay, so I mean that's an awesome story to tell. I always think this slide is kind of funny. I think we're poking fun at others, but this is really just us saying, hey, we're the only ones with guaranteed approval. Okay, and that's still the case. Look at the average cost on the guaranteed approval here. 28 bips. Why is that? Well, because the net amount at risk is lower, right? So because they're secure issue, their coverage ratio, right? So David got 315%. Well, if that's 130% on 100,000, well, the net amount at risk is $30,000. Well, that's less risk from EquiTrust perspective. So the cost to the rider is less, right? So then their asset is performing better. So there's just no negative scenario here, at least as far as I'm concerned. And again, we grade out, One American and Global's product because they don't have guaranteed approval. The wellness benefit, I've talked about this. I'm not going to spend a ton of time on this, gang, because it's just, I think this is a post-sale conversation, quite frankly. If I were selling it, they're going to buy this because they get the need. They understand the product is strong. But this is not to be overlooked, right? So once we've got contract in place, I mean, I would talk about this and say, hey, we're going to circle back to this because we're going to find some additional benefit dollars for you, but we're also going to help you live a little healthier and hopefully extend out claim or eliminate claim in general. Ultimately, all they do is assign you a coach, okay? And they're going to put a path in place, things like getting your hearing checked, right? There's a direct correlation to dementia and hearing loss, right? So, hey, you're getting your hearing checked every year. Do you have a device that tracks your steps? Do you have a gym membership? Things like that they'll every 2 years apply a credit to and apply those benefit dollars to the benefit base. So, I believe that benefit based addition is almost secondary to the fact that they are living a healthier lifestyle and hopefully delaying claim. But again, extremely powerful and what I think brings Bridge and the concept together. Sales opportunities. Okay, so I mentioned this earlier, the 1035 exchange of older annuities, underperforming annuities that are out of surrender, or life insurance contracts. Someone that, hey, they bought a permanent life insurance policy, they understood the value of owning their life insurance, but now that need, maybe the kids are out of college, kids are out, they're adults, right? They've got this, product or this policy that has a cost basis of X and they've got growth and hey, should I cash it out? How should I handle this? They're going to have a taxable event. No, 1035 that over to Bridge. And by the way, it claims, so instead of having a taxable event on the, anything over the cost basis, that money comes out tax-free at claim. Okay, so that's where we're getting a lot of our big contracts right now, old annuity contracts and old life insurance, permanent life insurance contracts, and then liquid assets, money markets, checking, CDs. We get a lot of that, right? Where you've got folks that have multiple CDs maturing over a period of time. You guys have clients that applies to for sure. Okay. And then, the annual review process, every time I go to an event, someone's talking about, hey, how do you find prospects? How do you talk about it? And I think we kind of roll our eyes a little bit like, yeah, I get the annual review deal. What we put that on there for is, in my opinion, you got to change the conversation a little bit, right? They now know this is an issue. Most folks that are approaching or in retirement, they've received some kind of marketing collateral. Someone has talked to them about this, and you just have to get into your process, the verbiage to professionally disturb your client, right? And say, hey, or if you've got somebody, right, that's been denied for traditional long-term care or a hybrid product in the past, wow, what an opportunity. Those would be the first people I would call. Okay, what a great phone call to make. Hey, Mr. Customer, I know you understand that there's a long-term care need, and unfortunately you were declined by company X, Y, or Z. I've got a solution that has a guaranteed approval option. Can we meet next Tuesday at 2 o'clock? Boy, you're going to get a lot of yeses doing that. Okay, so that's where I think the biggest sales opportunities are. So in a quick review, right, I already told you, hey, where to put the stars, on this. Simplified underwriting, guaranteed approval, the indemnity claims process, completely digital underwriting process. Those are, to me, the big ticket items. The other stuff is learned. It's the details, right? All important, but the reason to sell and or buy the product. Okay, let's sum it up. Tell a story. You guys know this. The best salespeople I know are great storytellers. They make it emotional. I'm sure all of you do that today. For me, I talk about having your cake and eating it too. I keep referencing that because, boy, that's powerful. Your money can grow and over here on the right, protect you in case of a long-term care event. And then there's two things that matter, right, to most people. And this is why I would buy and will buy when I'm 55 years old, this product. Okay. I want to protect my memories, my kids' memories, my wife's memory of me, right? And if I was in person with you, I'd show you a picture of myself, my son, both my sons, and my wife. My oldest son is holding up what looks like a baseball, but it's actually a cupcake. It's after a baseball tournament. We had, they had a really good weekend, and they actually won the tournament. He did not hit a home run, but he got a cupcake. It was somebody's birthday, so he was pretty pumped up. I think he was more happy about the cupcake than the baseball tournament. But I look at that and go, that's what I want him to remember, right? I don't want him to remember dragging dad's butt to the bathroom or the shower or to a doctor's appointment or you name it, right? And struggling through that and erode those memories because, I don't have the proper planning in place. And the other thing is personal for me, right, is my dignity. I don't want that, okay? I'm a prideful person, as most people are. I don't want that. I want a nurse. I want a professional doing those things. I don't want my kids or my wife, or anyone else doing that. So to me, you do this because you preserve their memories for them and your dignity for you. And that's how I would sell this program. And it's a solution for all. So with that, Brittany, that is the end of my prepared statement. So if you got any questions that have popped up, I'd be glad to get into those.
We did have a few questions come in, so kind of have an active group here.
Awesome.
So I'll begin with the first one. It is asking about state availability. For those of you on the call from New York,
Yep.
I'm sorry, too bad, no go. Unfortunately, as we know in the industry, New York's just a tough one. Other states do include, where we're not yet approved, is California, Connecticut, Indiana, Maryland, Massachusetts, and Virginia. So Leon, any comments? Do we see anything maybe coming available in those states anytime soon?
Yeah, so I don't know if you can see, and we had talked about this. Can you see that I changed? I switched over to the microsite, or is that not showing up? Is it still my
We can
slides?
see it.
Okay, good. Yeah, because I was just going to hop in and just show everybody. I kind of pumped up the microsite earlier, so I get a lot of questions about stuff where I just show them like, hey, where do I find that? Right, and then here's your list. Okay, boom. So to your question, there are a couple of states we know we're not going to get. We're not going to get New York, and for whatever reason, maybe there's someone that's a little more educated on that. We're not going to get Indiana. That's one that's been a hard no. The rest of those states, we have relative confidence that we're going to get. California is a tough one, but our folks are confident we're going to get that eventually. And that's really the sentiment about the rest of the handful that we don't have. I think we're 44 states now. So we won't be in New York. We won't be in Indiana. The others, we still have a reasonable expectation that at some point we will. I don't have any concrete, like, they almost are fearful telling us, hey, in 2 weeks, because they know I'm going to be telling you guys. But the word we get is that we should, get in most states, just not Indiana and not New York. Good question.
All right.
Yeah.
Perfect. So I'll have you tackle this next one. Great question. What is the required licensing and training for Bridge?
Yeah, that's great. So you see this, I don't know by state, right? So you click on this, you can, oops, I clicked on the wrong one. Yeah, sorry, what the heck's the licensing thing? See, I tried to be slick there, and state licensure, where's that? Oh, did I miss it? They move it on?
Oh, right there.
Right there. There we go. Yeah. So licensing, learn more, that'll take you out, and then here you go. Okay, so then you can just walk through what's required by state. So find your state, right? So in Idaho, we got the 8-hour initial training, 4 hours. That's your CE. Then you need that within 24 months. Your refresher training every 24 months. And then this is the key one. Typically, some states require the health line, some don't. Most do, but you can see, like, it'll tell you, hey, do I need to have the health line? So in Arizona, you don't. We don't require any specific long-term care training unless it's designated here, right? So 8 hours of LTC, 8 hours of partnership training, which is our training. So it'll tell you, and you can see there's only a couple of states that require that. So I'm showing you this in the microsite just to illustrate that you can find it, right? Find almost any question that you have, you can darn near find, on the microsite.
And of course, if you have a specific state you're curious about, definitely call the team. We can look that up as well. But overall, in most states, we're going to need the long-term care CE partnership training where that's required. Leon just pointed that out. Yep. Also, your annuity state training. So depending on state, that could be that older NAIC state annuity training, or what they're now calling more best interest and suitability training. On top of those two certifications, there's going to be a brief product-specific training on Bridge you'll have to go through. So pretty much as long as we check mark all three of those boxes, you'll be good to go to take that application. All right.
Yeah. And look, the benefits of the Bridge training, it's educational, right? I mean, you're going to need to learn this stuff anyway. So, once in a while I have somebody push back on training. I'm like, well, we want you to be knowledgeable when you're talking to clients about it. But, and Brittany made the point, either, call her team and our sales desk will answer those questions. We got internals that can get to those too. So, but it's, always important. The last thing we want is you go out, engage in a sales process, submit an application, and now we can't issue it because we don't have the proper training and certification.
Yeah, so we always try to avoid that up front at all costs. So I know we want to respect everybody's time here. There is one more question that came over. Great question, so I want to make sure it gets asked. Didn't really talk about it, but Leon, qualified funds. What can you do for us?
Yeah, thanks. I kind of skipped over that, right? So we right now, this is a not qualified product only, okay? So that's where the find the money portion, that's why when I spend time talking about sales opportunities, right, where we're going to find the money. That said, we are currently in the early stages of Bridge 2.0, which will encompass qualified options and what that looks like. It'll be a different product, totally different filing, I don't have a date, even a quarter on that yet, but I do know that we're looking at that because we know that opens up, just an entirely different market. So right now, Bridge is non-qualified dollars only. Great question.
Perfect. And those that may have folks with qualified funds trying to look for a solution, again, call the team. Unfortunately, it's outside of EquiTrust right now, but we may be able to still find a solution that may fit. Okay, one more question, and then we're going to cut it off. So, last minute question. We had somebody jump on late. Can you review what the minimum premium requirements on the policy is?
Yeah, 50,000 initial premium. And then, let's say, I made the comment, I know sometimes this kind of gets lost in the shuffle. It's a flexible premium product, but the initial premium needs to be 50,000 at application. And then they can add dollars to the contract after that. All year one, dollars will capture the coverage ratio. After that, it's dollar for dollar. Good question.
Awesome. All right. So essentially, I want to thank everybody for joining us today. It's amazing that you all do take time out of your day to join us for these sessions. Leon, of course, thank you for co-piloting today's session. Again, if you still have questions or would like a one-on-one discussion, feel free to reach out to our team. Our number is 800-228-0008, or shoot us an email at ltci@jetter.com. Again, thank you, and I hope you all enjoy the rest of your day.
Have a great day.